folks, hope you're well. We've been having a conversation this morning and over the last few days within the Discord around Bitcoin, where it is in its current cycle, how it fits within the wider macro context, and just having kind of general conversations about what our primary thesis is at the moment, and what the risks are, both left and right tail risk around that thesis, and what we'd be looking for in terms of validations and invalidations for both the primary thesis and the validations for the tail risks as they move along in time. One of the questions that's come up this morning is around left translated and right translated cycles. It's something that a couple of members have asked if we could do a video to cover, so I thought I'd do something quickly just to talk through those. So before we get started on that, it's right to call out that the left translated, right translated thesis is something that certainly I personally have picked up from Bob Lucas and the excellent work that he does on cycles. When it comes to cycle theory, Bob generally is my go-to at the moment in terms of looking at that information. So by all means check out Bob's YouTube channel and his Twitter feed. There's a lot of excellent information on there. And I will say, this is my interpretation of that based on being prompted by Bob in terms of thinking about it in this regard. So some of the things that I'll say might be slightly different to what Bob would say, but the general thesis is going to be similar, given that I've built mine based on information that I've gleaned from Bob, or things I've learned from Bob over the years. So just to call that out up front, that we're not certainly taking any credit for left translated versus right translated cycles. This is just our interpretation of that for the current Bitcoin setup. So on the screen then is a chart that kind of shows this to try and help explain what this looks like. So when we talk about the cycles, we're looking at cycles bottom to bottom here, so from previous bottom to next bottom, and those are shown by the red time cycles that you can see there, the red dotted time cycles on the screen. For Bitcoin, I've used the most recent low and gone back 4 years for that notional 4-year cycle. These are just indicative sorts of times. There will be margin for error within that, so we're not saying that it's got to be exactly on that week or exactly on that date. It's just indicative timelines going back through the cycles. So looking back, we can see that the lows have come within a reasonable margin of error of those time cycles throughout the piece. Below that, just for reference, there are the green time cycles, which are the highs to highs or tops to tops, and it's just to show you where they sat within those cycles as well. So I've marked those off with horizontals in terms of the green verticals. So the green verticals are the tops and the red verticals are the notional bottoms in terms of that 4-year cycle. I've also added in there the halving dates, which is something that people talk around a lot, so those are in orange. And then the notional midpoints of that bottom to bottom cycle are in purple, so those purple verticals are the notional midpoints. I've put those in for a few reasons that we'll start to discuss. And the last thing to notice on that chart is the ghost pattern, if you like, or the other feed that's in there. Now, that is the Nasdaq, and that's the Nasdaq on the 16-year adoption cycle, or the 16-year internet adoption cycle, which again is something that Bob talks about a lot in terms of the 4 distinct 4-year cycles within a 16-year cycle and what happens at the end of that cycle. And the reason that I've put that in, the reason we've been talking about it, why it's relevant for now, is that if we adopt that method and apply it to Bitcoin, then we would be moving into what would be the final 4-year cycle of a 16-year adoption cycle of Bitcoin from its inception, similar to what we saw with that 16-year cycle for the internet, or the internet bubble as it's widely known. So the relevance of looking at that is that that cycle on the Nasdaq, it showed 4 distinct cycles of 4 years, give or take, the same as we've seen on Bitcoin. The first 3 of those cycles were all right translated, and the final 4th cycle became a left translated cycle with a blow off top, with then an extended bear market or a longer bear market coming after that. So obviously you start to join the dots as to why we're talking about this in terms of something we need to watch as a tail risk. Now, when we talk about left translated and right translated cycles, it really is as simple as where the high sits within the cycle. If the high comes in the first half of the cycle or the left half, then it's a left translated cycle. If the high comes in the second half or the right half of the cycle, then it's a right translated cycle. So that's the terminology we're talking about when we look at this. So left translated is the high comes in the left or first 50% of the cycle, and the right translated is the high comes on the right or the second 50% of the cycle. So as you can see in Bitcoin's history to this point, looking at the cycles in that regard, the high has always come in the second half. It's always been right translated. And that again is similar to what we saw on NASDAQ during that internet boom. So the halving is always something that's discussed a lot in terms of that cycle, and it's something that's been discussed a fair bit on Twitter and in other places like YouTube around the danger date, if you like, for this cycle becoming left translated. A lot of people are looking at the halving and thinking if we see an all-time high before the halving, then that indicates a left translated cycle and potentially an earlier top than people are used to, people being trapped as price declines after that. And a lot of people are surmising that if we get beyond the halving without seeing that all-time high, then we're essentially safe in that regard from a left translated cycle perspective. Now that's not my view on it at the moment, and that's what we've been discussing in Discord. And if you have a look at the chart here, you can see that within the cycles, the halving has moved to the left in every cycle and then moved to the left again in this one as a projection. So it actually started on the right of the first cycle and then moved to the left and then moved further to the left, and in this cycle it will, if the projected halving date comes to fruition, which is April 24, it'll move further to the left of the midway point in the cycle again. So for me, the halving is not as important as that actual midpoint of the cycle in terms of the risk. And one of the things I've highlighted on the graph in front, on the chart in front, is the previous highs within the previous cycle. So these purple dotted lines, those show on a weekly basis that, assuming that these time cycles are correct, that we've never seen the previous all-time high or the previous cycle high broken within the first half of the cycle. So that's the kind of danger point that we've been talking about in the Discord over the last few days and this morning, is that it's not so much the halving date we need to look for not seeing an earth before halving. It's the midpoint date, which is, roughly speaking, accounting for margin for error, November 2024. One of the things we've spoken about is the kind of psychology within that. So, if we were market makers and we were looking to trap as many people as possible, you would be looking to try and get beyond what many would see as a key inflection point, make people think they're safe beyond that inflection point, sucker them in, and then turn it around before the next key inflection point when euphoria is in the market. And the argument I've made this morning is that for me that's between the halving and the midpoint of the cycle. So between the notional April 2024 date and November 2024, if we go beyond the halving date and we haven't reached all-time high yet, then a lot of people are going to start looking at that as it's going to be a right translated cycle. We've got another year to 2 years before we see the cycle high. We can keep accumulating, keep buying. We can look at the narratives at the moment that we see around about ETFs and bringing new money essentially into the market, bringing new people into the market. And if it was going to be a left translated cycle at that point, then that period between the halving and the midpoint would be where you would post your actual cycle high and trap as many people as possible before turning it around in that point. So that's the risk that we're talking about this morning in the Discord. And the reason we look at that is, if we look at the similarities between the NASDAQ 16-year internet adoption cycle, and we look at what happened towards the end of that. So in the last cycle, we saw a lot of new money coming in, a lot of new entrants to the market. Everyone was buying internet stocks at that point in time. The general public were coming in. Euphoria was coming into the market. We got that huge blow off top, and then after that point, as new people were coming in and still coming in and still coming in, the market turned. We saw biggest single day losses in history. We saw a hugely prolonged bear market after that, and a lot of people sitting in negative equity because of that euphoria at the end. And when you look at what's setting up over the next 12 months, if you like, the narratives that we're already starting to see play into that around about ETFs, institutional adoptions, people being able to put Bitcoin in their pensions, all that stuff, that news and that positivity is very similar in terms of that NASDAQ cycle, that internet cycle that we saw, the boom cycle that ended in 2000 to 2002. For those of us who were around then, it is very similar in terms of the starting point for it, and if we see that euphoria start to build over the next 12 months, it gives rise to this risk that we're discussing here. So, as I say, this is not a projection, it's not our primary at this point in time that we think we're going to see a left translated cycle. It's just a risk that we're aware of, and we're aware of the similarities, we're aware of the internet adoption cycle, how that was fairly similar to Bitcoin's adoption cycle at the moment. And although history never repeats, as we know, and you'll have heard this a million times, it does often rhyme, so it's a risk that we need to be aware of. We know the inflection point that we're looking for, it's that time period between the halving and the midpoint of the cycle. And if we see a new all-time high set during that time period, then our risk management needs to be tight in terms of making sure that we're not getting caught on the wrong side of that cycle. Now, the other thing I need to mention in terms of the cycles, and this is not so much the left translated, right translated thing. If we go and have a look at the primary thesis that we have at the minute, just quickly. Scroll this down. So this is my primary thesis at the moment, which is very similar to the other guys within the Discord, and that is that we've started a new cycle. The lows are in. We're in a new wave one, essentially, from an Elliott perspective. Now, the assumption here is that the previous Elliott cycle completed, and what we've just seen is an ABC or a corrective after the end of a cycle, and we're now moving into a new Elliott wave cycle as well as a new Bitcoin cycle. Now, you can make arguments for that. I'll cover why you can make arguments for a flip side of that as well, but my count shows this primarily, or my primary count shows this as a new cycle, with 1, 2, 3, and this being a fourth that we're in of the macro wave one of that cycle. And that would say that, or that would suggest that we're still short a fifth wave in this particular impulse, and that fifth wave, based on the previous counts, would project around about that kind of 42.7 type area, which is right inside an order block, the order block that I've discussed for many months within the Discord, and we saw the initial reaction off the breaker that I've highlighted a few times as well. So that's my primary thesis on where we are at the moment within the new Elliott wave cycle. Now, you can make an argument within that there is a smaller 1, 2, 3, 4, 5 in there, and that the 5 is already completed, and that what we're actually seeing just now is a wave 2 pullback of that larger 5 set cycle, and that is a legitimate count as well. That there's nothing to suggest that couldn't be considered to be the count, but the invalidation for this count versus that count, in my mind anyway, is that wave 1 high that I've got marked at the moment. So if this is a 4, then we shouldn't see this current pullback draw down any lower than that 27.2 type area. So between 24.2 area. So between that 24.2 and 24.7 area, between the current low and the wave 1 high, or notional wave 1 high there, we can go in there and that would be fine. It would still maintain this structure for a final fifth. If we were to drop any lower than that and go beyond that wave 1 high at 24.2, so this one here, then that would suggest that this 5 wave count that we have in here is actually invalid, and that the count is actually 1, 2, that was the third, this is the fourth, and this is the fifth, which would then bring us down into this kind of area for a wave 2. So I think I've probably got that marked somewhere. Yeah, somewhere. I do. So that's it there. So that's that alternate count there is 1, 2, 3, 4, with that being the fifth and this being the kind of wave 2 area. So if we were to come below this, then anything in this range of 0.5 to 0.854, so 17.1 to 21.9 becomes a permissible range for a wave 2 from an Elliott perspective. Now the issue you'd have with that if you're looking at this as a standard Elliott cycle is that as a 1-2 is fairly low and it's fairly early in terms of the Bitcoin cycle and what we've seen previously. Although Elliott's not really related to time, it's still fairly early in terms of the current cycle. And the way we measure projections for that based on the wave 1 would suggest a 3 at around 47.5 and a potential 5 between 75 and 95-ish. So that's what that would project. Now what this doesn't count in that scenario that we spoke about earlier in the left translated cycle is it doesn't count that huge blow off that we saw in the Nasdaq. So this may be very low as a projection if we were to see that euphoric blow off that we saw in that market. So we need to be aware of that as well. We would know more once we see the third wave complete, and even further still once we saw the first wave within the final fifth wave complete. We could project where the fifth wave of the fifth wave would go at that point in time. So it's still early data wise. These are all kind of joining the dots very long time in the future on a macro scale, and it's kind of check it as you go in that regard. But this is what we'll be looking at in terms of that risk. So I don't think that is the primary. This is still my primary at this point in time, but we'll see potentially in October that 42.7 area, but I'm mindful that my invalidation for that is fairly simple. It's anything below that wave 1 high invalidates that, and then I start looking at this as the primary after that point, where that is a 1 and a 2, and then we're going to move into 3, 4, and within this, for me, the left translated cycle becomes more probable, not the primary overall in terms of that macro level, but it becomes more probable in my thinking. And the reason I say that is the previous cycles. I said at the start of this little segment that we assumed that the previous cycle was 5 completed waves, so this being 1, 2, 3, 4, and then a truncated fifth. So if I mark that on there so that we can see it, so we're all talking about the same thing. So we could assume that 1, 2, 3, 4, 5 and a truncated fifth. Now this does measure within Elliott waves margin for error for a set of 5. I think the assumption that a lot of people make, particularly new traders and new technical analysts when it comes to Elliott wave, is that they assume because Bitcoin runs a 4-year cycle that every 4-year cycle needs to have a completed Elliott wave cycle within it, and that's not the case. Elliott wave doesn't care about Bitcoin's 4-year cycle or anybody else's 4-year cycle. It only cares about the structure of the market and the structure of its own schematic, if you like. So although I said this was my primary based on everything that we've seen and trying to fit it together with the variables around the 4-year cycle, this is equally valid at the moment. So that could be a 1, 2 with this a 3 with a 1, 2, 3, 4, 5 within it. 1, 2, 3, 4, 5 within it. So this is actually the fifth wave of 3, which is what I discussed earlier and then within the Discord, with this being a wave 4, if you like. And I could also make the argument that this whole thing was a wave 4 from a flat expanded perspective. That probably fits better for me, if I'm being honest. But either way, this being a 3 and this being a 4 and this being a potential fifth. Now this, as I say, is a valid count. It's not my primary count, but there's nothing to invalidate it at this point in time. This low stayed right within margin for error without going too low to invalidate it. It stayed above the wave 1 high, as we spoke about earlier. And in that scenario, that left tail risk that we just spoke about in terms of this being the final fifth of this cycle would project that high around this 75 to 95 type area. And it would also, from a time perspective, because we're just waiting for the last wave set of a fifth wave of a previous cycle, work fairly well with a left translated cycle if we were to get that early high. And as I say again, that projection doesn't take account of any blow off top that we might see within the left translated cycle that would be similar to what we saw within the Nasdaq cycle. And if I go back to that chart and show that again, so you can see what I'm talking about. What I'm referencing there is this massive blow off that we saw in the Nasdaq at that point in time. Where if you look at that chart, and you can do that in your own time, you'll see that the cycles were fairly consistent until we got to that last one, and then it was euphoric blow off and then huge crash after. So we'd have to be mindful that that's still a possibility, even if this does become a left translated cycle, that those projections for lower highs are wiped out by the blow off of the new money, the institutional money, before we see that turn at the top. So that's what we've been discussing essentially. So our primary thesis still remains that this is the start of a new Bitcoin 4-year cycle. There are many things pointing towards the bottom, having been in for quite some time here. As you know, we've been accumulating within that for a while. We have a fairly clear inflection point just now in terms of the previous low and the previous high, so that 24.2 to 24.7 range. Anything lower than that is still a buying opportunity in terms of that bottom being in. It's just a buying opportunity that we might need to be mindful that from a risk perspective, the high that you're aiming at might come either earlier or lower than you're expecting, unless we see that blow off that we saw on Nasdaq if we compare it to that time period during the internet bubble. So lots of variables in there. I think, as you know, within the Discord, we don't do absolutes in terms of projections. This is all if this then that, and this is our thesis in terms of how we look at it. So, and I say this is my specific thesis, but it's very similar, I think, to the rest of the guys based on the conversations that we have regularly. And obviously Caesar had mentioned this morning that it was one that he agreed with as well in terms of the risk and the thesis that we're putting forward from a structural perspective. So, as I say, primary still there. It's a 4-year cycle. We're looking at holding that low and holding that area between 24.2 and 24.7. If we don't and we drop lower, even as low as 17, then it's still a buying opportunity. That just potentially is a buying opportunity for a different end point outcome than we're currently looking at the moment, which would be that standard 4-year cycle move higher into the year after the halving, so into 25, 26 kind of time frame as opposed to 24. So that's where hopefully it makes sense. Any questions, ask in the Discord, and just a quick little recap on what we've been talking about. Speak soon. Until next time, stay safe. My tea's it. Gotta go.